What's going on, everyone? We have a pretty important rule filing to talk about that just came out of the SIBO exchange, and this was, I believe, it came through yesterday at 3:07 in the morning. And what this one is it is a rule change which SIBO is proposing to amend its rules to permit orders comprised of options and futures legs. So future-option orders is what they're going to be calling it. Text of the proposed rule change is provided in Exhibit 5. So essentially here, let's go into the purpose. The purpose of this rule change is to permit future option orders, which would be comprised of both options and futures legs. Doesn't that sound great? The exchange understands it is common for investors to engage in hedging or other investment strategies that involve options and related future products. However, to execute those investment strategies, investors must submit the options order to the exchange and separately submit the futures order to a designated contract market, or DCM, on which the futures trade. For example, market participants may obtain positions in SIBO Volatility Index, or the VIX, through transactions on the exchange and hedge those positions, entering into a separate transaction on SIBO Futures Exchange LLC. So separate executions of this sort create additional risk, including risk that one order will execute while the other does not, and price risk resulting from time it takes to complete both transactions. The exchange understands that due to those risks and the complexities of multi-part transactions, market participants may instead transact in the over-the-counter market or not obtain a hedge at all. The proposed rule change adopts a mechanism to facilitate the execution of these cross-product transactions in a simple, efficient manner that reduces the execution and price risk. So anybody that's been trading futures and options who's had to go through this process of trading separately, this actually may be a good thing for you because now it's going to be streamlined into one order type. They first proposed to adopt the definition of what a future option order is, and specifically, the proposed rule change amends Rule 1.1 to define such an order as an order to buy or sell a stated number of units of an underlying or related futures contract or contracts, coupled with the purchase or sale of an options contract or contracts on the exchange. The exchange would designate in which classes future options orders would be available. And then it says down here for Supernote 3, pursuant to Rule 1.5, the exchange announces all determinations it makes pursuant to the rules via specifications, notices, or regulatory circulars with appropriate advance notice, which will be posted on the exchange's website or as otherwise provided by the rules, electronic message, or other communication method is provided in the rules. The exchange intends to initially permit future option orders overlying VIX. However, the exchange may expand the availability of future option orders to other underlying securities or indexes in the future. So they're specifically targeting the VIX right now, and they say if it's required, the exchange would submit rule filings. That's a typo there. The exchange and would submit rule filings in connection with any such expansion. For example, the exchange may determine that a different risk offset requirement than what is proposed in the filing is appropriate for another underlying based on the characteristics of the overlying options and futures. So they're combining these two different previously separate order types into one, supposed to streamline the process for those who are opening, an options tied to a futures order tied to an options leg. So they do give some pretty important stuff related to their modeling here. And it says right here, the delta value of a future leg equals the amount set forth in the rules or contract specifications of the designated contract market on which the future contract trades. The delta value of each option and future leg is multiplied by the applicable multiplier. The sum of the future legs delta values divided by the sum of the options legs delta values, which equals the net delta value for that order. For VIX future orders, the system will calculate the risk offset described above using the net delta value for each group of option legs and future legs within the same expiration date. So if any of you running scripts out there, that's your key right there. That's your input variables. You're going to be looking for stuff with a net delta value for each group, which is the same expiration date with the options leg and futures legs. And also, furthermore, the net delta value of each group must be no greater than negative 0.10 and no less than negative 1.25. Now, what's interesting about this is that we know that delta being negative applies to put options. However, I need to look and see if net delta, actually let's just look that up real quick. Can net delta be negative? Yes, okay, well that solves that problem. So anyways, if it weren't for that, then we could have just said, oh, well, it's going to be puts. But anyways, sell 1 December VIX future with a delta of -1, buy 2 January VIX futures with a delta of 1, that offsets, buy 16 December VIX option calls with a delta of 0.5, and then buy 35 January VIX option puts with a delta of -0.6. This is their this is an example component of such an order. But anyways, yeah, it's pretty relevant because those of you that are trading in futures and options and may trade both, now you're going to get a streamlined order that could benefit you quite a bit and eliminate some of those risks that you would incur from placing a trade separately that they mentioned at the beginning of this. So I'll link this below if you're going to read the rest of it. That's basically the gist of it. The rest just goes and explains what the rules mean and everything. So if you're interested in that kind of stuff, I'll leave it below so you can read it. But anyways, that's it for SIBO 2024-042.